Welcome to the Traders Expo 2017 here in New York City. I'm Matt McCall, joined by Dr. Ellman of the Blue Collar Investor. Dr. Ellman, thanks for joining us here today.
My pleasure to be here.
So, options guru, let's talk about mistakes, because a lot of people jump headfirst in options, make a lot of mistakes. Any advice we can give to people out there?
Well, I see the most common mistake is that a lot of these people start way too soon. When you're selling options the way I do, covered call writing, selling cash secured puts, there are three major strategies and approaches you have to master before you get involved in risking even 1 penny of your hard-earned money. Those three skills are selection of the underlying security. Not every stock or ETF is appropriate for option selling. Then selecting the most appropriate option. It could be in the money, it could be out of the money, it could be 1 week, it could be 1 month. I favor 1 month options, that's my sweet spot. A lot of our members like weeklies. I wouldn't go further out than that, but that's based on my methodology. And also position management. Once you enter a trade, you buy a stock, you sell an option, what do you do if the price of the stock goes way down? What do you do if the price of the stock goes to the moon? What do you do if there's an ex-dividend date before expiration? You don't want to lose your shares. Or what do you do if the strike price is in the money as expiration is approaching and you don't want to lose your shares? So you have to be prepared and master all three of those required skills. So one of the mistakes is a lot of the people that I see start too soon. They get excited about the strategy, and yet they don't have the time to master the skills. They get started too soon, they lose a little money, and then they get disenchanted. A second very big mistake that option traders make related to covered call writing and selling cash secured puts is that they go for the highest premiums. So they look for stocks that generate the highest time value returns. Now, everybody likes to make a lot of money, but there's always the other side of the equation. Why are we getting so much premium from these underlying securities? And the answer is there's a high implied volatility component to these stocks. In other words, the market is anticipating a huge change in the price of that stock, but it doesn't tell you in which direction it's going to go. So if you get, for a near the money strike, a 1 month return of 8 to 10%, you are taking a huge risk. Now, covered call writing is a conservative strategy for conservative investors where capital preservation is very important. So I always stay away from very high premium returns because I know the risk is going to be very high.
That's great advice. Let me go back to your number one, your first criteria, stock selection, ETF selection. Just talk briefly about how you do go about that stock selection.
Well, the stock selection is basically three-pronged. I always do a fundamental analysis of the stock first, earnings and revenues. The reason I do that is because the institutional traders, I'm talking about mutual funds, hedge funds, banks, insurance companies, they love stocks that are making money and increasing revenues. So I want to be on that team. So we look at fundamentals first. Then we do chart technicals. We read the price chart. I use 4 parameters when I'm evaluating a stock. I look at trend identifying. I use the 20-day and 100-day exponential moving averages because I'm trading within a 30-day time frame. So the 20-day EMA kind of lines up with that. And then I use the 100-day as a comparison. So you want the 20-day to be higher than the 100-day. Then I use 2 momentum identifying indicators. I use the MACD histogram and the stochastic oscillator. So it gives me an idea of the actual momentum behind that stock movement. And then I confirm everything with volume. So those 4 technical indicators, and the third prong to screening, what I call common sense indicators, like minimum trading volume, asset allocation, avoiding earnings reports, and things like that. After those 3 screens, you have a watch list of about 30 to 50 stocks instead of thousands that are out there now. And those are great candidates for option selling.
That's great advice. You have a plan. You always must have a plan, and don't jump in too quickly.
Well
Thank
said.
you very much, Dr. Ellman for the Blue Collar Investor. Thank you so much for joining us.
Pleasure.